Warren Edward Buffett was born on August 30, 1930, in Omaha, Nebraska, during one of the darkest moments in American history. Just 10 months earlier, the stock market had crashed on Black Tuesday, and by the time Warren arrived, the Great Depression was tightening its grip on America. Banks were failing at a rate of more than 600 per year, unemployment was climbing toward 25%, and families were losing their homes, savings, and futures. In Omaha, breadlines stretched around blocks and men who once wore suits to offices now stood in soup kitchens. Warren's father, Howard Buffett, knew this terror intimately. Howard was a stockbroker, one of the most hated professions in Depression-era America. In 1931, when Warren was just 1 year old, Howard's employer collapsed and he found himself unemployed with a wife, young son, and another child on the way. He had no income, no prospects, and bills piling up. For months, the Buffett family survived on borrowed money and the kindness of relatives. But Howard refused to give up. In the depths of the Depression, he did something that seemed insane. He started his own brokerage firm, Buffett, Fork and Company. He worked 18-hour days, knocking on doors, convincing frightened people to trust him with what little money they had left. Slowly, impossibly, the firm survived. Warren grew up in a household obsessed with money, not because his parents were greedy, but because they had lived through losing everything. Dinner table conversations revolved around interest rates, stock prices, and business cycles. While other kids heard bedtime stories, Warren heard about compound interest. His father would explain how $1 saved at age 10 would be worth far more than $1 saved at age 30. Time was the secret ingredient. Warren absorbed every word. He was fascinated by these discussions that most children found boring. By age 6, Warren was already different. In the summer of 1936, he noticed something at his grandfather's grocery store. People bought Coca-Cola in 6-packs for 25 cents, about 4 cents per bottle. But if you sold them individually, people would pay 5 cents per bottle. Warren saw the opportunity immediately. He bought 6 packs from his grandfather for 25 cents, walked through his neighborhood, and sold each bottle for 5 cents. He made 5 cents profit per 6-pack, a 20% margin. At 6 years old, Warren Buffett had discovered arbitrage. He was conducting market research, noticing people bought more on hot days and that some neighborhoods paid more reliably than others. Most 6-year-olds played with toys. Warren was running a business, optimizing distribution, and analyzing customer behavior. His sister Doris later recalled that Warren had no interest in normal kid activities. He didn't play baseball or go to dances or chase girls. He just wanted to make money and study businesses. The family thought something was wrong with him. But this obsession, this focus that seemed strange to everyone else, was the seed of what would make him the greatest investor who ever lived. He loved the game of business for its own sake, not for what money could buy, but for the intellectual puzzle of how wealth was created. When Warren was 7, his father showed him his coin collection. Howard hadn't collected coins for nostalgia, he had noticed certain old coins traded above their face value. Warren helped catalog them, learning a profound lesson. Identical items could have wildly different values based on rarity, condition, and demand. A penny could be worth 1 cent or $100 depending on these factors. This planted a seed in Warren's mind that would grow into his core investment philosophy: price and value are different things. Most people confused price with value, thinking something was worth whatever someone would pay for it right now. Warren learned early that value was intrinsic, based on what something could produce over time, while price was just what people were willing to pay at the moment, driven by emotion and circumstance. In March of 1942, when Warren was 11 years old, he made his first stock purchase. He had been saving money from various ventures including paper routes, selling golf balls, and working at his grandfather's store. He had accumulated $114, equivalent to about $2,000 today. He convinced his sister Doris to invest alongside him. They bought 3 shares of Citi Service Preferred at $38 per share. Warren had studied the stock and read everything he could find about the company. The numbers looked good. But immediately after he bought, the stock dropped to $27. Warren was terrified. He had lost money, and worse, he had lost his sister's money. Doris was upset. Every day Warren checked the price, hoping desperately it would recover so he could escape with dignity. The stock did recover and climbed back to $40. The moment it crossed his purchase price, Warren sold. He made $5 per share, $15 total, about a 4% return. He felt relief flood through him. Then the stock went to $200. Warren watched in agony as the investment he had sold continued climbing. This experience shaped the next 70 years of his investing life. He extracted 3 lessons he would cite for the rest of his career. First, don't sell out of fear. He had sold because he was scared and wanted to break even, an emotional decision, not a rational one. Second, ignore price fluctuations. The daily movement from 38 to 27 didn't change the company's value, only his perception changed. Third, be patient. The big gains come to those who wait. Selling at 40 was not losing, but it meant missing the real opportunity. This became his mantra for life: the stock market is a device for transferring money from the impatient to the patient. At 13, Warren filed his first tax return. He reported income from his paper route and deducted $35 for his bicycle and watch as business expenses. He used them for his paper route, so they were legitimate business costs. At 13 years old, he was thinking about tax optimization. The IRS approved the deductions. At 14, Warren took $1,200 he had saved and bought 40 acres of Nebraska farmland. He rented it to a tenant farmer for $25 per month, $300 per year. That was a 25% annual yield on his $1,200 investment. He was 14 years old, already diversifying income streams, thinking about capital allocation, understanding yield and return. What's remarkable isn't that Warren was smart. Many kids are smart. It's that he was obsessed. Other kids his age played baseball, went to dances, hung out with friends, and tried to meet girls. Warren read financial manuals, studied stock tables, filled notebooks with business analysis, and calculated compound interest in his head for fun. His sister Doris recalled that Warren had no interest in normal kid stuff. He just wanted to make money and study businesses. It was weird, and they thought something was wrong with him. But the weirdness was the key. The trait that would make him the greatest investor ever was visible at age 6, an insatiable need to understand how money worked, not for toys or status, but for its own sake. Warren's father Howard was not a typical parent. He was a stockbroker who became a 4-term Republican congressman, serving from 1943 to 1949 and again from 1951 to 1953. He was one of the most principled men in Washington, which made him unusual. Howard believed the government was printing too much money and that deficit spending would destroy the dollar. His values were absolutist. He voted his conscience even when it was politically damaging. Once he cast the only vote against a bill he thought was unconstitutional. His motto was "I'd rather be right than president." He refused campaign contributions over $50 and never took lobbying money. The lessons Warren absorbed from Howard shaped everything about how he would live and invest. First, independence is everything. Howard's political independence came from not needing anyone, not donors, not party bosses, not special interests. He could vote his conscience because he wasn't beholden. Warren internalized this completely. His entire investment approach would optimize for independence, not maximum wealth. Second, reputation is irreplaceable. Howard's integrity was his brand, and people trusted him because he consistently chose principle over expedience. Third, think for yourself. Howard voted against his party constantly when he thought they were wrong. Warren learned that you're right not because others agree with you, but because your facts and reasoning are sound. Fourth, money is freedom, not status. Howard drove used cars, lived in a modest house, and didn't care about impressing people. He valued financial security for the autonomy it provided, not the status it signaled. Warren absorbed this completely. He still lives in the house he bought in 1958 for $31,500. He drives his own car, eats at McDonald's, has no yacht, no private island, no entourage. He optimized for independence and used money as the tool to achieve it. But Howard was also emotionally distant, obsessed with politics and principle. He created pressure that Warren internalized, a need to prove himself, to earn approval through achievement. Warren loved and respected his father but wasn't close to him emotionally. Warren's mother Layla was a different force entirely. She was intelligent and capable, but deeply unhappy. Layla had ambitions that were thwarted by the expectations of her time. She came of age in the 1920s when women had just won the right to vote, went to college when few women did, and was smart enough to have a career. But society expected her to be a housewife and mother. The frustration of unfulfilled potential turned inward and came out as anger, often directed at her children. Layla could be warm and loving one moment, then cruel and withholding the next. She had a volcanic temper and would berate Warren and his siblings over small mistakes, making them feel worthless. Then she would act as if nothing had happened. Warren learned to cope by withdrawing emotionally, by seeking approval through achievement rather than intimacy, by building walls that protected him but also isolated him. His relationship with his mother taught him that the people who are supposed to love you can hurt you deeply, that emotions are dangerous and unpredictable, and that it's safer to live in your head where you have control. This shaped his emotional life profoundly. He became someone who could analyze businesses with perfect rationality but struggled with emotional intimacy. Someone who could be generous with money but withholding with feelings. The wounds from Layla never fully healed, but Warren learned to channel the pain into relentless achievement. Warren attended public schools in Omaha, then moved to Washington, D.C. when his father was elected to Congress in 1942. Warren hated the move. He was 12 years old, torn from his friends, his city, his life. He acted out, ran away, and refused to cooperate. He told his parents he wanted to go back to Omaha but they refused. He was miserable in Washington, lonely and angry at his parents for disrupting his life. But he channeled the unhappiness into the one thing that gave him control, making money. His paper routes in Washington became obsessions. He didn't just deliver papers, he studied the routes, optimized them, and built a system. By age 15, he was earning $175 per month from paper routes, equivalent to about $2,500 per month today. That was more than many adults earned. Warren attended Woodrow Wilson High School in Washington. He was socially awkward, more interested in business than fitting in. He had few friends and didn't date. He spent his free time reading annual reports and stock tables. His classmates thought he was weird, but Warren didn't care about popularity. He cared about compound interest and return on capital. In 1947, when Warren was 16, his father's congressional term ended and the family moved back to Omaha. Warren was thrilled. He enrolled at the University of Pennsylvania's Wharton School at age 16, graduating high school a year early. But he hated Wharton. He thought the professors knew less about business than he did. After 2 years, he transferred to the University of Nebraska where he could finish his degree quickly and cheaply. At Nebraska, Warren took 18 to 20 credits per semester and finished in 3 years, graduating in 1950 at age 19. He had already accumulated $9,800 from his various business ventures, equivalent to about $100,000 today. He was 19 years old with more capital than most adults. His plan was to skip graduate school and start investing, but his father insisted he continue his education. Warren applied to Harvard Business School, confident he would be accepted. Harvard rejected him, saying he was too young and not mature enough. The rejection stung, but it turned out to be the luckiest break of his life because it led him to Columbia Business School and to the man who would change everything, Benjamin Graham. Warren had read a book that transformed how he thought about investing. The Intelligent Investor by Benjamin Graham, published in 1949. Graham's central insight was simple but revolutionary. A stock is not a piece of paper whose price bounces around based on emotion and speculation. A stock is a piece of a business. The value of that business can be calculated based on its assets, earnings, and cash flows. Sometimes the stock price is far below the business value. When that happens, you buy. You hold until the price rises to match the value. Then you sell. This is value investing. Buy dollar bills for 50 cents. Graham called it margin of safety. Don't buy something at fair value and hope it grows. Buy something well below fair value so you have a cushion if you're wrong. Warren read The Intelligent Investor and felt like scales fell from his eyes. This was it. This was the secret. Everything he had been doing instinctively now had a framework, a methodology, an intellectual foundation. Warren learned that Graham taught at Columbia Business School and he applied immediately. Columbia accepted him. In 1950, at age 19, Warren moved to New York to study under his hero. Graham's class was unlike anything Warren had experienced. Graham didn't teach theory, he taught real investing with real examples. He would put a company on the board, usually an obscure one nobody had heard of, then work through the valuation. If it was selling for less than book value, especially less than net working capital, you had a margin of safety. Warren was the best student Graham ever had. He was the only student Graham ever gave an A+. Warren absorbed everything, asked brilliant questions, and stayed after class to discuss ideas. He wanted Graham to hire him at his investment firm, Graham Newman Corporation, but Graham said no. He hired mainly Jewish analysts because Wall Street firms discriminated against Jews at the time. Graham wanted to give opportunities to people who couldn't get them elsewhere. Warren was disappointed but understood. He went back to Omaha in 1952 at age 21 with a Columbia MBA and nowhere to work. He started working at his father's brokerage firm as a broker and analyst. He hated selling but loved analyzing companies. His returns were excellent, but he was miserable in the role. In 1952, Warren married Susan Thompson, a woman he had met in Omaha. Susie was everything Warren wasn't: outgoing, warm, emotional, and social. She saw beneath his awkward exterior to the brilliant, wounded person inside. She loved him and believed in him. They married when Warren was 21 and Susie was 19. Their first child, also named Susan, was born in 1953. Warren now had a wife, a daughter, and responsibilities. He needed to make money. He kept working at his father's firm, kept analyzing companies, and kept buying stocks for himself with the capital he had accumulated. His personal returns were extraordinary. He was beating the market by massive margins. In 1954, Ben Graham finally offered Warren the job he had wanted 2 years earlier. Come to New York and work at Graham Newman. Warren jumped at the chance. He moved his young family to White Plains, New York, and went to work for his hero. The job was everything he had hoped. Warren analyzed companies, recommended investments, and learned Graham's methods firsthand. But he also saw Graham's limitations. Graham's approach was purely quantitative: find cheap stocks based on numbers alone. Don't worry about quality of the business, strength of management, or competitive advantages. Just buy cheap, sell when price reaches value, and move to the next one. Warren began to question this. What if you found a truly great business with durable competitive advantages, excellent management, and growth potential? Shouldn't you pay a fair price for quality and hold it forever, rather than buy mediocre businesses cheap and sell them quickly? In 1956, Ben Graham decided to retire and close Graham Newman. Warren was 25 years old and out of a job again, but now he had valuable experience and a track record. He moved his family back to Omaha. He had saved about $140,000, equivalent to about $1.5 million today. He could live on that, invest it conservatively, and never work again. He had achieved financial independence at 25. But Warren didn't want to retire. He wanted to invest, to build capital, to prove himself, to play the game he loved. In May of 1956, on his 26th birthday, Warren Buffett started his first investment partnership with 7 limited partners who contributed a total of $105,000. Warren contributed $100. The partnership was the beginning of everything. Warren ran it from his house, using a bedroom as an office. He had no employees, no infrastructure, just himself and a telephone and stacks of annual reports. He worked alone, reading and analyzing companies 14 to 16 hours per day. He was looking for undervalued investments trading below book value or liquidation value. He found them in obscure places, small companies nobody followed. He would buy large positions, sometimes 30 to 40% of the portfolio in a single stock. This was concentrated investing, the opposite of diversification. Warren believed that if you found something truly cheap, you should bet big. Diversification was protection against ignorance. If you knew what you were doing, concentration made sense. The partnership returns were spectacular from the start. In 1957, the market fell 8.5% while Warren's partnership was up 10.4%. In 1958, the market was up 43% while Warren was up 40.9%. Year after year, he beat the market by wide margins. Limited partners made money and Warren's 25% cut of the profits grew his personal wealth rapidly. More importantly, his reputation spread. Friends told friends. By 1960, Warren was managing multiple partnerships with dozens of investors. In 1962, he consolidated them into a single partnership, Buffett Partnership Limited. Assets under management grew to $7.2 million. Warren was 31 years old, managing millions, beating the market consistently, and building wealth for himself and his partners. In 1959, a mutual friend introduced Warren to Charlie Munger at a dinner in Omaha. Charlie was 35, 6 years older than Warren. He was a successful Los Angeles attorney with no particular interest in stocks. But both men were from Omaha and both had worked at Warren's grandfather's grocery store, though they had never met there. Both loved ideas, argument, and intellectual combat. The conversation at dinner lasted hours. They discussed business, human nature, decision-making, everything except small talk and weather. Charlie later recalled he could tell this young man was an unusual intellect. What happened next became one of the most successful intellectual collaborations in investment history, not because two smart people combined IQs, but because they had complementary blind spots. Each saw what the other missed. Warren brought encyclopedic business knowledge and instant valuation calculations. He could look at a balance sheet and income statement and tell you in seconds what a company was worth. But Warren was a Graham disciple, focused on buying cheap and ignoring quality. Charlie brought something Warren lacked, multidisciplinary frameworks from law, psychology, physics, and biology. He thought in terms of systems, incentives, and human behavior. He was willing to pay up for quality rather than always buying the cheapest thing. And he had brutal honesty that cut through rationalization. When Warren was wrong, Charlie told him with no sugarcoating, no deference, just truth. Charlie's most important lesson to Warren was simple but profound: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. In 1962, Warren started buying shares of a struggling textile company called Berkshire Hathaway. This was supposed to be a quick flip. Berkshire was trading below book value, losing money, but had working capital Warren could unlock. He planned to buy it cheap, push for liquidation or sale, make a quick profit, and move on. But something went wrong, or rather, something went right in a way Warren didn't expect. As he bought more shares, as he got to know the management, as he thought about the assets, Warren realized this wasn't a quick flip. This was an opportunity to control a company, to redirect its capital, to build something. In 1965, Warren gained control of Berkshire Hathaway, taking over as chairman. He was 34 years old. The textile business was dying, unable to compete with cheaper southern mills and foreign imports. But Berkshire had something valuable: it generated cash flow from operations, even if the business itself wasn't profitable. Warren realized he could use that cash flow to buy other businesses, better businesses, and transform Berkshire from a textile manufacturer into a holding company. This was the beginning of the Berkshire Hathaway we know today. But the transformation would take time and would require Warren to learn some painful lessons about buying bad businesses, even when they're cheap. The textile operations continued losing money through the late 60s and into the 70s. Warren kept them running partly out of loyalty to the workers and the community, but also because he was stubborn. He was learning that cheap isn't always good, that some businesses are cheap for excellent reasons. In 1969, Warren shocked his partners by announcing he was closing Buffett Partnership Limited. He was 38 years old, had been running the partnership for 13 years, and had an extraordinary track record. From May of 1956 to December of 1969, the partnership had achieved a cumulative return of 2,795% compared to the Dow Jones Industrial Average return of 152%. An investor who put $10,000 into the partnership in 1956 would have had about $286,000 by the end of 1969. Warren's personal share had made him wealthy, worth about $25 million. But Warren saw something others didn't. The market in 1968 and 1969 had gone crazy. Growth companies were trading at 50, 60, even 80 times earnings. It was speculation, not investing. Warren couldn't find bargains anymore. Everything was overpriced. Rather than compromise his standards, rather than buy expensive stocks and hope they went higher, he decided to return capital to his partners and close the partnership. This was extraordinary discipline, walking away at the peak of a bull market because he couldn't find value. Most investors would have kept the fees flowing, kept buying something, and rationalized that this time was different. Warren offered his partners two choices. They could have their money back in cash, or they could have shares in Berkshire Hathaway, which Warren now controlled. Many partners chose Berkshire shares. They trusted Warren more than they trusted themselves to invest the cash. This turned out to be one of the best decisions any of them ever made. From 1969 forward, Berkshire Hathaway became Warren Buffett's life work. No longer constrained by partnership structures, no longer needing to distribute cash annually, Warren could hold investments forever. This was crucial. The partnership had forced short-term thinking. With Berkshire, Warren could buy and hold indefinitely. This aligned perfectly with his evolving philosophy: find wonderful businesses, pay fair prices, hold them forever, and let compound interest work its magic over decades. In 1972, Warren bought Cease Candies for $25 million. This was expensive by Graham standards. Cease earned about $4 million per year, so Warren paid more than 6 times earnings. Graham would never have done this. But Charlie convinced Warren that Cease had something precious: brand power. People loved Cease chocolates and had emotional attachment. They would pay premium prices. Cease turned out to be one of the best investments Warren ever made. Not because it grew enormously, but because it generated cash consistently. Over the next 30 years, Cease would generate more than $1.3 billion in cumulative pre-tax profits while requiring almost no additional capital investment. Warren could take those profits and invest them in other businesses. Cease taught him the power of brands, of pricing power, of businesses that generate cash without needing constant reinvestment. From Cease forward, Warren looked for businesses with strong brands, loyal customers, pricing power, and minimal capital requirements. These were worth paying up for. In 1973, Warren made another investment that showed his thinking evolving. He bought a major stake in the Washington Post company. The Post was trading at about $80 million market value, but Warren calculated it was worth at least $400 million. The 1970s also brought Warren and Charlie Munger fully together as partners. In 1975, Berkshire bought Blue Chip Stamps, a trading stamp company Charlie had been involved with. This effectively merged their investment activities. From this point forward, they were true partners, making every major decision together. Their process was simple. Warren would do the analytical work, reading annual reports, calculating valuations, and identifying opportunities. Then he would call Charlie. He would explain the investment thesis. Charlie would think for a moment, then either say it's brilliant, do it, or he would punch holes in the logic and point out what Warren missed. This back and forth made both of them smarter. Warren later said Charlie made him a better investor not by teaching him new techniques but by helping him unlearn bad habits from his Graham training. By the late 1970s, Berkshire's strategy had crystallized. Use the cash flow from insurance operations, from cease Candies, from other businesses to buy more wonderful businesses. Hold them forever. Let compound interest work. Reinvest profits into new opportunities. Never sell unless absolutely necessary. This was different from the traditional investment approach where you buy low, sell high, and repeat. Warren's approach was buy right, hold forever. The power was in the holding. If you own pieces of great businesses and held them for decades, the compound returns would be extraordinary. But you had to be patient. You had to ignore price fluctuations. You had to think like a business owner, not a stock trader. This required temperament as much as intelligence. The 1980s saw Berkshire's strategy fully mature. Warren had figured out what worked: buy wonderful businesses at fair prices. The textile business was finally shut down in 1985 after decades of losses. Warren admitted it had been a mistake to buy Berkshire Hathaway in the first place. If he had invested that capital elsewhere, particularly in a good insurance company from the start, Berkshire would be worth much more. But he had learned from the mistake. He learned that cheap isn't always good, that some businesses are terminal no matter what you do, and that capital allocation is everything. Where you put money matters more than how hard you work. Put money in a bad business and work hard, you'll get poor returns. Put money in a great business and do almost nothing, you'll get rich. In 1983, Warren made one of his most important investments. He bought Nebraska Furniture Mart from Rose Blumkin, a Russian immigrant who had built the store from nothing. Warren paid $60 million for 90% of the business. But more importantly, he learned from Mrs. B, as everyone called her. She was 90 years old, working 7 days a week, still running the store. Her secret was simple: sell for less than anyone else, keep costs brutally low, treat customers honestly, and work harder than the competition. She had no business degree, no sophisticated strategy. Just relentless focus on customers and costs. Warren saw in her the essence of great business. It's not complicated. Give customers more value than they expect, keep your costs lower than competitors, and compound over time through reinvestment. Warren's investment philosophy by the mid-1980s was complete. He looked for businesses with several characteristics. First, simple and understandable. If he couldn't understand how a business made money in 10 minutes, he passed. Second, consistent operating history. He wanted businesses that had been around for decades, not startups or turnarounds. Third, favorable long-term prospects. Demographic trends, market structure, and competitive position all had to point toward continued success. Fourth, honest and competent management. He needed people he could trust to run the business without constant oversight. Fifth, attractive price relative to intrinsic value. He wouldn't overpay, but he would pay fair prices for quality. And sixth, preferably businesses that didn't require constant capital reinvestment. He wanted cash generators that could fund new investments. This checklist sounds simple, but it was remarkably effective at filtering out bad investments. Most businesses failed one or more of these tests. Technology companies were too hard to understand. Turnarounds were uncertain. Commodity businesses had no pricing power. Companies needing constant reinvestment generated poor returns. By being disciplined, by saying no to almost everything, Warren could wait for the perfect pitch. He didn't have to swing at every opportunity. He could be patient and deploy capital only when he found exactly what he wanted. This patience was his superpower. While other investors felt pressure to invest, to do something, Warren could sit on cash for years waiting for the right opportunity. When it came, he would bet big. In October of 1987, the market crashed. On October 19th, Black Monday, the Dow Jones fell 22% in a single day, the largest one-day percentage drop in history. Panic spread through Wall Street. People thought the financial system was collapsing. Brokerages were overwhelmed. The crash seemed to come from nowhere. The market had been making new highs just weeks before. Now it was in free fall. Warren's phone rang constantly. Partners, friends, and business associates all calling in panic. What should they do? Should they sell? Was this the start of another Great Depression? Warren's response was simple: he did nothing. He reviewed his holdings, confirmed the businesses themselves were sound, and went to bed. The companies he owned were worth the same on October 20th as they had been on October 18th. Only the prices had changed. This was the essence of Warren's temperament advantage. While everyone else panicked, he stayed calm. Not because he was braver, but because he had a framework that let him separate price from value. Price is what you pay. Value is what you get. A business generates cash flows over decades. A one-day drop in stock price doesn't change those cash flows. So why panic? In fact, the crash created opportunities. Suddenly great businesses were on sale. Warren began buying. Within weeks, he had deployed hundreds of millions into stocks that had been expensive before the crash and were now reasonably priced. The market recovered. Within 2 years, it had surpassed its pre-crash highs. Warren's purchases in the panic generated enormous returns. His calm during the crisis reinforced a lesson: temperament matters more than IQ. The crash of 1987 taught Warren something else. Market crashes are opportunities, not disasters. Every few years, sometimes more often, markets go crazy on the downside. Fear overwhelms reason. Everything gets sold, even great businesses. If you have cash and courage, you can buy wonderful things cheaply. But you need cash. You can't take advantage of crashes if you're fully invested or using leverage. This insight shaped Berkshire's capital structure forever. Always keep some dry powder. Don't use leverage. Be ready to act when others are paralyzed by fear. The market is a mechanism for transferring wealth from the impatient to the patient, from the fearful to the brave, from those who act on emotion to those who think clearly. In 1988, Warren began buying Coca-Cola stock. This seemed obvious in retrospect. Coke was one of the most recognized brands in the world, sold in nearly every country, had massive pricing power, and generated huge cash flows. But it hadn't been obvious for years. Coke stock had gone nowhere through most of the 70s and early 80s. Management had been distracted, trying to diversify into unrelated businesses and losing focus. But in 1981, Roberto Goizueta became CEO and refocused the company on its core business, selling soda concentrate to bottlers. This was a brilliant business model. Coke manufactured concentrate for pennies and sold it to bottlers for dollars. The bottlers did the capital-intensive work of bottling, distributing, and marketing. Coke collected cash with minimal capital investment. Warren started buying in 1988 when Coke was trading at about 5 times earnings before interest and taxes. Over the next year, he bought more than $1 billion worth of stock, eventually owning 7% of the company. This was Berkshire's largest position and represented about 40% of the entire portfolio. It was concentrated, but Warren had conviction. He understood the business. He trusted the management. He believed the brand was irreplaceable. And he thought the growth potential was enormous. Billions of people around the world would drink more Coke as they became wealthier. The investment was simple: growing unit volume times pricing power times minimal capital requirements equals compounding cash flows. Hold it forever and the returns would be extraordinary. Coca-Cola worked even better than Warren expected. By 1998, Berkshire's $1 billion investment was worth $13 billion. That's a 13-fold return in 10 years, a 28% compound annual return. But Warren didn't sell. Why would he? Coke was still generating growing cash flows. The brand was as strong as ever. There was no reason to sell a wonderful business just because it had appreciated. Capital gains taxes would take a third of the profit. Better to hold, let the company keep compounding, and defer taxes indefinitely. This was another key insight Warren developed over time. The best businesses are the ones you never sell. Every time you sell and buy something else, you pay taxes and transaction costs. That friction drags down returns. If you own something wonderful and hold it forever, you avoid all that friction and let compound interest work at maximum efficiency. The 1990s were Berkshire's greatest decade. The stock price compounded at over 25% annually. A shareholder who bought in 1990 and held through 1999 saw their investment increase almost tenfold. Berkshire's market value grew from $4 billion to over $120 billion. Warren became one of the richest people in the world, though he lived exactly as he had before. Same house, same car, same habits. The wealth was just a byproduct of doing what he loved. He loved analyzing businesses, finding value, and deploying capital wisely. The money was a scorecard, not the goal. The goal was playing the game better than anyone else. But the late 1990s also brought challenges. The dot-com bubble was inflating. Internet stocks were soaring to absurd valuations. Companies with no profits, often no revenue, were worth billions. The logic was that the internet changed everything, that old metrics didn't apply, and that whoever grabbed market share first would dominate forever. Warren was skeptical. He had seen manias before. He knew that businesses had to generate cash eventually to be valuable. But he couldn't value internet companies using his methods. He didn't understand their economics. How would they make money? What were their competitive advantages? How much capital would they need? He couldn't answer these questions, so he didn't invest. This made him look foolish for a while. Berkshire's stock fell in 1999 as tech stock soared. Investors mocked Warren as a dinosaur, out of touch with the new economy. Warren endured the criticism quietly. He didn't chase the bubble. He didn't pretend to understand businesses he couldn't value. He stuck to his principles even as it cost him performance. In 1999, the Nasdaq index rose 86% while Berkshire's stock fell 19%. Investors abandoned value investing for momentum. Why bother with analysis when you could buy anything with .com in the name and watch it triple? Warren kept his discipline. He knew how this would end. He had seen bubbles before, in the 1960s and in the late 1920s. They always ended badly. When price becomes disconnected from value, when speculation replaces investing, when everyone believes this time is different, disaster follows. He just had to wait. The bubble burst in March of 2000. The Nasdaq peaked at 5,100, then collapsed. Over the next 2 years, it fell to 1,600, down 70%. Hundreds of internet companies went bankrupt. Trillions of dollars in market value evaporated. Companies that had been worth billions were worth nothing. The investors who had mocked Warren went silent. Those who had abandoned value investing came back, humbled. Warren's discipline was vindicated. He hadn't missed the new economy. There was no new economy. There was only the old truth that businesses have to make profits to be valuable, that high prices eventually meet reality, and that patience and rationality beat speculation and mania. Berkshire's stock soared as investors fled technology and sought safety in real businesses with real profits. September 11, 2001, brought different challenges. Terrorist attacks on New York and Washington killed thousands and traumatized the nation. The stock market closed for 4 days. When it reopened, stocks plunged. Travel and insurance stocks were hit especially hard. Berkshire-owned insurance companies and analysts speculated that Berkshire might face billions in losses from its insurance exposure. Warren addressed this quickly. He calculated that Berkshire's share of World Trade Center losses would be about $2.5 billion. This was large but manageable. Berkshire had the capital to pay all claims and keep operating. More importantly, the attacks would reshape the insurance market. Premiums would rise dramatically as insurers repriced terrorism risk. This would benefit Berkshire's insurance operations for years to come. Within days of the attacks, Warren acted boldly. While most investors were paralyzed by uncertainty, he assessed what had changed and what hadn't. The attacks were horrific, but they didn't fundamentally change American business or economic prospects. Once the shock passed, life would go on. Companies would keep selling products. People would keep consuming. The economy would recover. But prices had fallen across the board. This was opportunity. Warren didn't try to time the absolute bottom. He didn't wait for clarity. He acted while uncertainty was highest, deploying capital into businesses he understood at prices that made sense. This willingness to act decisively during crisis, to buy when everyone else is selling, was one of Warren's most valuable traits. It's only possible if you have cash ready and nerves of steel. But 2008 would bring the greatest crisis of Warren's career and the greatest opportunity. The financial crisis that began in 2007 and accelerated through 2008 threatened to destroy the global financial system. It started with subprime mortgages, loans made to borrowers who couldn't afford them, packaged into complex securities and sold to investors worldwide. When housing prices stopped rising and started falling, these securities became worthless. Banks that owned them faced massive losses. Credit markets froze. Banks stopped trusting each other. By September 2008, major financial institutions were failing. Lehman Brothers declared bankruptcy. Merrill Lynch sold itself to Bank of America to avoid collapse. AAG, the giant insurer, needed a government bailout. The stock market was in free fall. Every day brought new disasters. On September 15, 2008, at 6:47 in the morning, Warren's phone rang. A voice said Lehman Brothers had filed for bankruptcy. This was unprecedented. Lehman was one of the largest investment banks in America, in business for 158 years. Its failure sent shockwaves through the financial world. If Lehman could fail, anyone could fail. Banks stopped lending to each other. The commercial paper market, which funds day-to-day corporate operations, froze. Companies couldn't borrow to make payroll. The real economy was grinding to a halt. Stock markets crashed worldwide. Retirement accounts lost half their value. People were terrified. This looked like another Great Depression. But Warren Buffett was calm. While every financial institution on earth was paralyzed with fear, Warren saw opportunity. Within days, he would deploy $15.5 billion, buying stakes in Goldman Sachs, General Electric, and other companies at crisis prices with favorable terms. This wasn't courage or luck. This was 78 years of preparation for exactly this moment. On September 23, 2008, Goldman CEO Lloyd Blankfein called Warren. Goldman needed capital to shore up confidence. Would Berkshire invest? Warren said yes, but on his terms. Berkshire would invest $5 billion in Goldman preferred stock paying 10% annual dividends. Plus, Berkshire would get warrants to buy common stock at a favorable price. If Goldman survived and prospered, Berkshire would make billions. If Goldman failed, Berkshire would be ahead of common shareholders in bankruptcy. Warren was getting paid well for taking risk, but he had structured the deal to minimize downside. The Goldman investment stabilized markets psychologically. If Warren Buffett was willing to invest in Goldman, maybe things weren't as bad as they seemed. Within hours of the announcement, Goldman's stock price stabilized. Other financial stocks bounced. Warren's investment was a vote of confidence that mattered because of who he was and his track record. Days later, Warren made a similar deal with General Electric, investing $3 billion on favorable terms. Again, the announcement helped stabilize markets. Over the following months, Warren continued deploying capital. He bought municipal bonds yielding attractive rates. He invested in distressed debt. He bought stocks of solid companies at panic prices. By the time markets bottomed in March 2009, Berkshire had invested tens of billions. The recovery from 2008 vindicated Warren's strategy completely. The Goldman preferred shares eventually generated $3.5 billion in dividends and capital gains. The GE investment produced over $2 billion. The stocks Berkshire bought during the panic doubled and tripled as markets recovered. By 2013, the S&P 500 had surpassed its pre-crisis highs. Berkshire stock had more than doubled from the bottom. Warren's net worth, which had fallen below $40 billion during the crisis, climbed past $60 billion. But the money wasn't the point. The point was that the system worked. Buy wonderful businesses at fair prices. Hold them through volatility. Deploy cash aggressively during panics. Be patient during manias. Over time, this simple approach had produced extraordinary results. Warren's age became a topic of conversation. He was in his 80s, still working full-time, still sharp, still making great decisions. But mortality was real. What would happen to Berkshire when Warren died? He addressed this openly in his shareholder letters. Berkshire's culture and structure would endure. The board had a succession plan. Investment managers had been hired to handle the portfolio. Operating company CEOs ran their businesses autonomously. Berkshire would continue compounding, maybe not at the same rate, but successfully. Warren had built something bigger than himself. The machine would keep running. His legacy was secure, not in his personal wealth, but in the principles he had taught, the businesses he had built, the shareholders he had enriched, and the investors he had inspired to think rationally about capital allocation. By 2020, Berkshire Hathaway had become one of the largest companies in the world, worth over $500 billion. It owned dozens of operating businesses including Geico, BNSF Railway, Berkshire Hathaway Energy, and scores of others. It held massive stock positions in Apple, Bank of America, Coca-Cola, American Express, and many more. It employed nearly 400,000 people. It had generated wealth for millions of shareholders who had held the stock for decades. A share that sold for $19 in 1965 was worth over $300,000 by 2020. Someone who invested $1,000 in 1965 and never sold would have over $15 million. Warren's secret was never really secret. He had explained it thousands of times in letters, interviews, and speeches. Buy businesses you understand. Focus on long-term value, not short-term price. Be patient. Be disciplined. Be rational when others are emotional. Don't use leverage. Save cash for opportunities. Think independently. Admit mistakes. Learn continuously. Treat people fairly. Keep your word. It sounds simple because it is simple. But simple doesn't mean easy. The hardest part isn't understanding what to do. The hardest part is having the discipline to do it consistently for decades, especially when it's unpopular, especially when you're being mocked, especially when everyone else is getting rich doing the opposite. What made Warren Buffett exceptional wasn't genius-level intellect. Plenty of people are smarter. What made him exceptional was the combination of intelligence, discipline, temperament, and longevity. He was smart enough to understand businesses and valuation. He was disciplined enough to stick to his principles. He had the temperament to stay calm during crashes and ignore manias. And he kept doing this for 70 years, from age 11 buying his first stock to age 90 still running Berkshire. The compound effect of good decisions over 7 decades, the accumulated wisdom of seeing multiple market cycles, the network and reputation built over a lifetime, these advantages were unbeatable. Warren's relationship with money evolved as he aged. In his youth, accumulating wealth was proof of competence, a way to keep score, a path to independence. In middle age, it became a responsibility. With great wealth came the obligation to use it wisely. In 2006, Warren announced he would give away 99% of his fortune, most of it to the Bill and Melinda Gates Foundation. He had spent his life accumulating capital and allocating it efficiently in markets. Now he would let others allocate it to social causes. This wasn't guilt or obligation. It was pragmatism. He had been lucky to be born in America, to have the skills the market valued, to live in an era when capital allocation was rewarded handsomely. He had won the ovarian lottery. Giving the money back was simply rational. The lessons from Warren's life extend far beyond investing. His story teaches that compound interest is the most powerful force in wealth building, but it requires time and patience. It teaches that temperament matters more than intelligence, that staying calm and rational when others panic creates enormous advantages. It teaches that you can say no to almost everything and still succeed wildly by saying yes to the few perfect opportunities. It teaches that understanding businesses deeply, studying them obsessively, thinking about them constantly, gives you an edge that can't be easily copied. It teaches that holding forever is often better than buying and selling, that minimizing friction and taxes and decisions improves returns. It teaches that being contrarian is uncomfortable but necessary, that the crowd is usually wrong at extremes. Warren's relationship with Charlie Munger exemplified the power of partnership. They worked together for over 40 years, making every major decision jointly. Their success came not from agreeing on everything, but from challenging each other, from Charlie pushing Warren beyond Graham's limitations, from Warren grounding Charlie's theoretical frameworks in practical business analysis. They made each other smarter. This is rare in any field, especially in investing where egos are large and lone genius is celebrated. But Warren understood that partnership, that having someone smart you trust who will tell you when you're wrong, is more valuable than any individual brilliance. He credited Charlie with transforming him from a value investor focused only on cheap prices into someone who appreciated quality businesses. Without Charlie, Berkshire would be a fraction of its current size. The Berkshire model Warren built has no real equivalent in corporate America. It's neither a traditional holding company nor an operating company. It's not a private equity fund or a mutual fund. It's something unique, a permanent capital vehicle that buys businesses and holds them forever, that treats operating company CEOs with autonomy and trust, that maintains a tiny headquarters staff, that has no investor relations department or PR team, that reports results honestly even when they're poor, that refuses to give quarterly guidance or manage earnings. This structure works because of the culture Warren instilled. Decentralization, trust, long-term thinking, integrity, rationality. These aren't just words. They're embedded in how Berkshire operates. Critics have argued that Berkshire's success is unreplicable, that Warren's track record includes too much luck, that his advantage was simply getting started when markets were less efficient and having 70 years to compound. There's truth in this. Starting in the 1950s, when information was scarce and competition was limited, gave Warren opportunities that don't exist today. Having 7 decades for compound interest to work is an advantage no one starting today will have. But this misses the point. Warren's value isn't in providing a blueprint others can copy exactly. It's in demonstrating principles that work across time. Patience beats impatience. Rationality beats emotion. Quality beats cheap. Independence beats consensus. Focus beats diversification. These lessons apply whether you're investing in 1960 or 2025. Warren's life also illustrates the cost of extreme focus. He optimized everything for investing. His diet, his schedule, his relationships, his hobbies, everything served the goal of thinking clearly about business and capital allocation. This produced extraordinary results in his professional life, but it came with trade-offs. His first marriage eventually faced challenges, partly because Susie needed emotional connection Warren couldn't provide. His children felt they came second to Berkshire. He missed family events and prioritized work over presence. He would admit later that he could have been a better father and husband. The intensity that made him a great investor made him a challenging partner and parent. This isn't unique to Warren. Most people who achieve extraordinary things in one domain make sacrifices in others. As Warren entered his 90s, Berkshire's strategy evolved. The company had become so large that finding investments big enough to move the needle was difficult. Warren could no longer buy small companies or make concentrated bets in stocks. Everything had to be enormous. A $1 billion investment was a rounding error for Berkshire's $500 billion portfolio. This size constraint limited opportunities. Warren had to focus on the very largest companies, buying entire railroads, making multi-billion-dollar equity investments, negotiating unique deals during crises. The advantage was that Berkshire could write checks few others could match. The disadvantage was that most opportunities were now too small to matter. The COVID pandemic in 2020 brought another test. Markets crashed in March as the virus spread and economies locked down. The S&P fell 34% in a month. Panic returned. But this time, Warren didn't deploy capital as aggressively as he had in 2008. He held back, waiting for better opportunities. Critics questioned whether he had lost his nerve, whether age had made him cautious. But Warren explained his reasoning. The Federal Reserve and government had responded with unprecedented support, injecting trillions into markets and the economy. This backstop reduced risk but also reduced bargains. Unlike 2008 when the system was on the brink, 2020 saw massive intervention that stabilized markets quickly. Warren preferred to wait for true crisis conditions when he could buy at bargain prices and favorable terms. Looking back across Warren's 90-plus years, several themes emerge. First, the importance of starting young. Warren made his first investment at age 11. By age 30, he had been investing for 19 years and had built substantial capital. That 20-year head start was crucial. Second, the value of obsessive focus. Warren didn't have hobbies. He didn't pursue balance. He devoted essentially all his waking hours to studying businesses and thinking about capital allocation for 70 years. This level of focus is rare and produces rare results. Third, the power of learning from mistakes. Warren made many bad investments, but he studied each one, extracted lessons, and didn't repeat the error. This continuous learning over decades built wisdom others couldn't match. Fourth, the advantage of independence. Warren never had a boss after age 25. He never answered to anyone except his own conscience and his shareholders, whom he treated as partners. This independence let him think long-term, make contrarian decisions, and ignore quarterly pressures. Fifth, the multiplier effect of reputation. Warren's honesty and integrity over decades made people trust him. This trust gave him access to deals others couldn't access, let him deploy capital during crises, and attracted the best people to work with him. Reputation is an asset that compounds like money. Sixth, the benefit of choosing the right partner. Charlie Munger made Warren better, challenging his thinking, broadening his perspective, and preventing mistakes. The right partnership is priceless. Seventh, the necessity of temperament. Warren stayed calm during crashes, ignored manias, and resisted social proof. This wasn't natural talent. He had trained himself over decades to control emotions, to separate price from value, to think clearly when others panicked. Eighth, the magic of compound interest over time. Warren's wealth came not from spectacular annual returns but from good returns compounded over 7 decades. Time is the key variable. Give good returns enough time and they produce extraordinary wealth. This is why starting young and never stopping matter so much. Ninth, the value of a strong balance sheet. Warren never used leverage. He always had cash ready for opportunities. This conservative capital structure let him act boldly when others couldn't. 10th, the importance of continuous learning. Warren read voraciously his entire life. He spent 5 to 6 hours daily just reading, studying businesses, learning about industries, and understanding competitive dynamics. This intellectual curiosity kept him relevant across different eras of business. What worked in 1960 was different from what worked in 2020, but the underlying principles remained constant because Warren kept learning and adapting. His willingness to admit what he didn't know, to stay within his circle of competence, to expand that circle slowly through study, gave him an edge that persisted. Warren's legacy extends beyond his personal wealth or Berkshire success. He changed how people think about investing. Before Warren, stock picking was seen as speculation, something close to gambling. Warren showed it could be rational, disciplined, based on business analysis rather than chart patterns or momentum. He demonstrated that buying pieces of good businesses and holding them long-term produced better results than trading actively. He proved that you didn't need inside information or complex strategies. Simple logic applied consistently worked. This democratized investing, making it accessible to ordinary people who could think clearly and control their emotions. Warren also influenced corporate governance. His shareholder letters set a standard for transparency and honesty that many companies now try to emulate. His model of decentralized management, trusting operating company CEOs to run their businesses without interference, showed an alternative to centralized corporate bureaucracy. His refusal to split Berkshire's stock or pay dividends demonstrated respect for shareholders' intelligence and tax efficiency. His willingness to admit mistakes in public, to discuss what Berkshire paid for its learning, created a culture of accountability rare in corporate America. Beyond business, Warren's life illustrates the relationship between money and happiness. He achieved extraordinary wealth but maintained modest habits. He found joy not in consumption but in the game of investing, in friendships, in learning. His philanthropic commitment showed that wealth beyond what you need for independence and security doesn't add much to life quality. He could have lived anywhere, bought anything, but he stayed in Omaha, ate at McDonald's, drove ordinary cars, and lived simply. This wasn't frugality born of deprivation. He could afford anything. It was freedom from needing status or luxury. The wealth was abstract, numbers on a page. What mattered was the freedom to spend his time as he wished, doing what he loved, with people he respected. As Warren entered his 10th decade, his role evolved from investor to teacher and icon. His annual shareholder meetings in Omaha attracted 40,000 people, pilgrims coming to hear him and Charlie dispense wisdom for 6 hours. These weren't typical corporate meetings. They were part business update, part philosophy seminar, part comedy show. Warren and Charlie would answer questions on everything from accounting rules to the meaning of life, mixing serious insights with self-deprecating humor. The meetings became legendary, a ritual for value investors worldwide. They symbolized what Warren represented: rationality, integrity, continuous learning, good humor, and humility despite massive success. The greatest tribute to Warren isn't the wealth he accumulated but the principles he taught and the lives he influenced. He showed that success doesn't require being the smartest, having the best education, or knowing the right people. It requires rationality, discipline, patience, and continuous learning. These qualities can be developed. You can't increase your IQ much, but you can improve your temperament. You can learn to control emotions, to think independently, to be patient, to avoid mistakes. This is empowering. It means anyone willing to do the work can improve their investing and their thinking. Not everyone will become Warren Buffett, but everyone can become a better version of themselves by applying his lessons. Warren's relationship with time is perhaps his most important lesson. He thought in decades while others thought in quarters. He held businesses forever while others traded constantly. He was patient when opportunity wasn't present and aggressive when it emerged. He understood that time is the friend of wonderful businesses and the enemy of mediocre ones. He let time do the heavy lifting and didn't try to force results. This long-term orientation is rare because humans are impatient, because careers are measured in years not decades, because the pressure to show results is constant. But Warren proved that if you can resist these pressures, if you can truly think long-term, the advantages are enormous. The discipline to do nothing most of the time, combined with the courage to act boldly on rare occasions, summarizes Warren's approach. Most investors do the opposite. They're constantly active, trading frequently, responding to every news item. They're timid during crises when boldness would help. Warren inverted this. He did almost nothing most of the time, just studied and waited. But when opportunity emerged, when markets crashed and others panicked, he acted with a boldness that seemed reckless but was actually carefully calculated. This inversion, being patient when others are active and bold when others are fearful, was his secret weapon. It's emotionally difficult, which is why few can do it, which is why it works. Looking at Warren's entire career from 1956 to 2025, what stands out isn't any single decision but the consistency. 70 years of applying the same basic principles. 70 years of buying businesses he understood, of paying fair prices for quality, of holding through volatility, of ignoring market noise, of thinking independently, of learning from mistakes, of compounding capital. The consistency is what produced the extraordinary results. Not genius insights or perfect timing, but good decisions repeated thousands of times over 7 decades. This is perhaps the most important lesson for anyone in any field. Sustained success comes from doing the right things consistently over long periods, not from occasional brilliance. The essence of Warren Buffett's story is that ordinary principles applied extraordinarily well over an extraordinary length of time produced extraordinary results. There was no secret beyond being rational, patient, disciplined, and consistent for 70 years. These qualities sound simple, even boring. But they're rare because they're difficult. Being rational when everyone around you is panicking or speculating requires strength most people lack. Being patient for decades while others get rich quickly requires discipline most people can't sustain. Being consistent through multiple boom and bust cycles requires conviction most people don't have. Warren had these qualities, developed them deliberately, and applied them relentlessly. That's the secret. Not genius or luck or connections, though those helped, but simple qualities sustained longer than others sustained them.